Okay, class, welcome to part two of chapter 4 here. Let's continue on with holding period return here. The advantages, of course, it's easy to calculate, easy to understand, and it considers current income and growth. Disadvantages, of course, we don't use the time value of money, and rates may become inaccurate if time periods is longer than 1 year. Okay, let's turn to another method, internal rate of return. Determines the compound annual rate of return earned on an investment held longer for more than 1 year. The yield, or the IRR, is the annual rate return earned by a long-term investment. It is also defined as the discount rate that provides a present value of benefits received equal to the present value of the costs divided by investments. Unlike the holding period return, it takes into account the time value of money and can be used to calculate the return on investments held over a year. The holding period return is inappropriate for investments held more than 1 year. Let's look at an example here. Let's say you had an investment costing $1,000 today, and it'll be worth $1,400 at the end of 5 years. Now, using your Texas Instrument calculator here, you could find the yield here. Of course, present value is $1,000. Future value is $1,400. Number of years, 5, and you compute the interest, and it's 6.96. As long as this meets your return, what you're looking for a return for this type of investment and your risk, it would be acceptable. If you're looking for a higher return, then you would probably not pick this particular investment. Okay, let's talk about finding the growth rate here for an income stream or dividends if we're looking at stock. When we go to chapter 8, you'll learn the constant growth model for stock valuation, and you'll have to figure out the growth rate of the dividend stream here. And we'll do this finding the growth rate. Okay, let's look at finding the growth rate here for table 4.8 here. Look at 1999. You see the stock is paying a dividend per share of $2.45. And let's turn to 2008. And the dividends have grown to $3.50 per share. Then again, taking out our calculator again here, we'll compute and find the growth rate here. Okay, we input $2.45 as the present value. Future value would be $3.50. You have 9 years, and you compute the interest, or in this case the growth, which will be 4.04, and that would be a 4.4 growth rate for dividends. And like I said, when we tackle chapter 8, you'll need to find the growth rate for an income stock. Okay, let's turn to sources of risk here. You have your risk return trade-off, and this is the relationship between risk and return, in which investments with more risk should, and I stress should, provide a higher return, and vice versa. If not, then you would not pick that particular investment. Now, risk is the chance that the actual return from an investment may differ from what is expected. Okay, now we're going to look at some of the different sources of risk here. Like I said, some of this you probably covered in your management courses here at Ashland. Okay, let's talk about currency exchange risk, which is risk caused by the varying exchange rates between currencies of two countries. And of course, we discussed this in chapter 2. Types of investments affected, of course, would be international stocks, ADRs, international bonds. Example of currency exchange risk is US dollar getting stronger than foreign currency, reducing the value of the foreign investment. Of course, if you want to hedge your risk here, you could use futures contracts or options to help hedge the risk of currency exchange risk. Okay, let's turn to business risks, which is concerned with the degree of uncertainty associated with investments earning and the investment's abilities to pay investors interest, dividends, and other returns owned by them. Business risk is usually related to the firm's line of business. Of course, this is going to affect common preferred stock. Examples of business risk would be decline in a company's profits or market share. A good example of that would be Nokia. You don't see them around too much, or bad management decisions. Okay, what does business risk mean? Okay, the risk that a company will not have adequate cash flow to meet its operating expense. Okay, then we have financial risks that companies will not have adequate cash flow to meet its financial obligations. Financial risk is risk, in addition, risk a shareholder bears when companies use debt in addition to equity financing. Companies that issue more debt instruments would have higher financial risk than companies finance mostly through equity or common stock. That's why when you do your financial analysis, you'll be looking at different leverage ratios. Okay, let's look at purchasing power risk. This is the risk of loss of cash due to inflation. Purchasing power risk is the chance that changing prices, levels, inflation, or deflation will adversely affect investments. Types of investments, of course, would be bonds, fixed incomes, and CDs. I mean, we talk about CDs right now. They're only paying about 1% interest. Okay, examples of purchasing power risk would be what movies this or last year was $8, and now you got to pay $9. So hopefully your investments would take care of that purchase power risk. Currently, CDs aren't doing that. Okay, let's look at interest rate risk, which is the chance that changes in interest rates will adversely affect the security value.
Hi, this is Kevin Brocious again. I'd like to take a couple of minutes to speak with you about some of the risks associated with bond investing. Unfortunately, there is a common notion among some investors that all U.S. government bonds have no risk. While U.S. government bonds have no default or call risk, they do share a common risk with all other bonds, and that is interest rate risk. Interest rate risk is the possibility that interest rates will change and thereby change the required return and bond value. For example, suppose you purchased a 5-year $1,000 bond today that is paying a 5% rate of interest. If interest rates for the same bond increase to 6% tomorrow, your bond will no longer have a market value of $1,000. If you choose to sell it, you will receive something less than your purchase price. Conversely, if interest rates for the same type of bond decrease to 4% tomorrow, your bond will be worth more than $1,000. So there is an inverse relationship between interest rates and all bond prices.
Okay, let's look at liquidity risk. We've already talked about this in past chapters. Here is the risk of not being able to liquidate an investment and to receive a reasonable price for it. Of course, this would be small company stock, real estate. I had that problem selling my place, had to lose money because real estate prices has gone down. Of course, if you price anything cheap, you can sell it quickly, but you are losing money, and that's liquidity risk. Let's look at tax risk here. It's the chance that Congress will change and make unfavorable changes in the tax laws, driving down the after-tax return and market value of certain investments. Let's look at 2000.
My name is Bill Cass, and I'm Director of Wealth Management Programs at Putnam. With me in the studio today is CPA and attorney Chris Hennessy. Chris is also a member of Putnam's Business Advisory Group. Clients have real concerns on the impact taxes will have on their ability to meet their fundamental objectives: saving for retirement, funding college education, having enough income in retirement, and transferring wealth. The good news is that we have some clarity with the passage of recent tax legislation to address the fiscal cliff, specifically the American Taxpayer Relief Act of 2012. Today we'll examine the key provisions of the new tax law and highlight considerations for effective tax planning in 2013. Chris, thanks so much for being here with us today.
Thank you, Bill, for having me.
We really went down to the wire on this, didn't we?
Yeah, I think 2 a.m. after New Year's Eve. So actually, we did go over the cliff and then came back up again.
Albeit temporarily.
Right.
Certainly a lot of drama in Washington. We've seen as a trend, certainly.
Yeah, and it'll probably come up again. We're going to talk about this, but in February, the end of February.
Right, with the debt ceiling. So, in any event, Chris, let's walk through the new legislation in some detail here. I want to start off by talking about income taxes. I think generally good news for people here.
Right, because what ended up happening is those single with above 400,000 of taxable bottom line income, 450,000 married, will have a rate increase from 35% to 39.6%, or the bracket will increase accordingly.
Right.
But as you well know, initially the number was much lower. It was somewhere in the range of 200 to 250. So I think that part is good news because it'll impact less people.
There was some compromise here, but the bottom line, for the vast majority of American taxpayers, they're really not going to see any changes in terms of income tax. Now, what about capital gains and dividends?
Right, so capital gains and dividends, the first good news is that the 15% rate was made permanent. However, again, those above those same cutoff numbers of 400 and 450 will see a jump to 20% in their dividend capital gains rate, only on the income above those numbers.
Now, on dividends, let's talk a minute about dividends, because if we had a full sunset, we were looking at dividends reverting back to ordinary income as high as 39.6. So
Right.
for those
Right.
clients that were concerned about if they're in dividend-paying stocks or dividend-paying mutual funds, very good news.
Very
there
good news,
on that
exactly
front.
right, yeah, exactly right.
And also, as far as capital gains, we still have that 0% rate, correct?
Yes, and that's still in the law. That has been extended, made permanent into the law. So in other words, if someone is all the way up to a 15% marginal tax rate, their cap gains rate will be zero. And that's good.
0% for the first two brackets, then 15% up into that last bracket, that new or renewed 39.6 bracket. They're going to be paying 20%.
Right. So I think that all
Okay,
is fairly
continuing
good
on with
news for the
sources of
investment
risk
world.
here, you
investment
get your
community.
market risk, which is the risk of decline in investment return because of market factor independent of a given investment. All types of investments are affected. Examples of market risk would be stock market decline on bad news, which we just seen here this week here, political change, change in the economic conditions. Okay, event risk comes from unexpected events that has a significantly and unusually immediate effect on underlying values and investments. Then again, these are all types of investments. You could have decrease in values of insurance company stock after major hurricanes, decrease in the value of real estate after major earthquakes. Toyota, you could add in there with their recall. How about BP and the oil in the Gulf of Mexico, and how about Apple when Jobs left and then passed away? Okay, let's look at table 4.2 here and look at some of the risk return trade-offs here. Of course, U.S. government securities are the safest, and as you move up here, the riskier the investment and hopefully the higher return. Then there will be bonds, preferred stock, convertible stocks, mutual funds, common stocks, real estate, options, and futures. So as the risk goes up, hopefully the return will also increase, or you should not accept that type of investment. Okay, lastly here, the steps in the decision process of combining risk and return. You're going to estimate the expected return using present value methods and historical or projected return rates. You're going to assess the risk of the investment by looking at the historical projected returns using standard deviations or coefficients of variation of returns. So you're going to use little statistics here. Now we talked about that. I gave you an example in the first week of using standard deviation to see the factor. You know, the more risk, the higher the standard deviation. You're going to evaluate the risk return of each investment alternative to make sure the return is reasonable given at the level of risk. And then you're going to select the investment vehicles that offer the highest expected return associated with the level of risk you are willing to accept. And you guys this week here are going to complete a risk assessment yourself, and whatever risk assessment level you're at, if it fits that particular investment along with their return, then you would decide to either select or decline a particular investment.